Hey everybody, Tradiest Trades here, back with another video, and today we're going to do something a little different than you're used to. I'm going to show you how I use market structure, price swings to determine a directional bias, and how I use the daily time frame then to enter into trades with high probability. And the best thing about this method of trading is it doesn't take up a whole lot of your time. You can place orders into the market at the end of the day when orders are on the table, and just let the trades play out, and you don't have to monitor intraday price action. So first of all, you have to have a bit of an understanding of market structure. So I'm going to clean up my charts a bit here. You don't need to see all these things. So market structure is basically marked out here with this zigzags. It's Larry Williams market structure on TradingView. It's marking out the short-term swing high, and swing low. And basically, when we get a swing high confirmed, that implies momentum is to the upside. And when we get a swing high confirmed, that insinuates that momentum is to the downside. So when you get a upswing here, that tells us momentum is to the upside, especially it's a monthly chart I'm looking at here. So I do this on the monthly and the weekly. So going on the daily chart, you'll see that when price took out this high, that confirmed the monthly swing low. So that tells me that for sure, the momentum is strong to the upside. We just put in a higher monthly low. We should anticipate now to go and make higher highs on the monthly. So what that means is I can buy oversold pullbacks. So you'll see here I've got percent %R on my screen. You can use valuation for this method as well. If you follow my channel, you know the ducks in a barrel strategy, and it's a very effective strategy. I've just tried to make things a little bit simpler. I want fewer indicators. I want fewer things to need to be in alignment, but still be high probability. And I found that this is the best way. And this is, in fact, Larry Williams uses the percent %R in this exact way to catch continuation of a trend. If you didn't get in back here, well, this will show us where to get in the middle of the move. So basically, once you've confirmed the momentum is to the upside, you've determined your directional bias. Essentially, is once this swing low has been put in, we confirm that we want to trade and we want to work the long side of the market. The next thing I look for is for the oversold reading on the percent %R. So I've got the 4, 14, and the 10 period RSI here. We can see here the green is the 4 period. It closed as oversold on this day. So when that happened, all I would be doing is putting in an order to buy it on a stop order at the high of that bar, and adjusting my stop based on how the 3 period ATR evolves. And if it didn't hit it the next day, well, after this day's bar, I would have to adjust again because the 3 period ATR would have changed, which basically is adjusting the stop based on the volatility. And then essentially all I'd be doing is getting triggered in on a stop and trailing the stop up below the true low of each day. So we would have basically caught a move up to here. It would have been approximately probably 1.5 risk reward ratio. And then again, just waiting for the oversold readings. So there we got the oversold reading. You can see here would have taken one loss with this approach because we would have bought on the high right here on this day, and it would have trailed us out. But since basically what I need to see is, I guess I kind of forgot to mention what else I look for. There needs to be a confirmation of the daily trend. So the daily trend needs to be in alignment with the monthly swing in order for me to take these oversold or overbought trades. So basically, the 18 period moving average method is this blue line's the 18 period moving average. For a bullish trend, you need to have 2 consecutive closes above the 18 period moving average, and they can't be inside bars. And then you need to see follow through the high of the highest bar of those 2 bars. So that happened here, so we know we're in an uptrend. Okay, so when we pulled back here, we started to get oversold on all 3 of the oscillators on the percent %R oscillators, and we dipped below the 18 period moving average, but we haven't had a trend change on the bearish side yet, because remember, we'd need 2 consecutive full range bars below the 18 period moving average, and then we'd need to take out the low of those bars in order to confirm the trend is bearish. So basically, we would have bought here, Stop a little bit below here. I wouldn't start trailing until we'd taken out the high of the swing that made the swing low that made this entry happen. So once we got up here, could start trailing your stop, and we would have got trailed out right about there. So that's a nice 2 hour trade, roughly 1.94 hour trade. So that's how I would use this method. So we can see there was another entry right here this week. On Monday, I guess it triggered on Tuesday. Got oversold, closed in the oversold, buy stop on the high, stop down here, and then start trailing below the true low of each day. So we'd be at guaranteed 1.32 are locked in profit right now. So that's how I use market swings to tell me which direction to trade the market, and then make sure the daily time frame is in alignment based on the 18 period moving average method of measuring the trend. I like that one because you'll notice if you throw the 12 Donchian on, it has some false breaks. Like you see in this dip back here, we triggered into a bearish trend technically based on the 12 Donchian, but we see the 18 period moving average hadn't switched yet. And out of all the trend following or trend change confirmation methods that I have learned, the 18 period moving average is the one that keeps you in the true trend for the longest period of time. So that's how I would use these market structure swings to determine the bias. You can use this on lower time frames. You could use daily swings and daily for your swings to determine the bias, and then the hourly chart for your entries. It also works for day trading. It works quite well on the 4 hour chart for your swings and your structure, and the 15-minute chart for entries. So there's no real need to go below the 15-minute chart for day trading. You can catch really nice moves just paying attention to the 4 hour chart for your bias for the day. But that's it for me on this video. Hope this is somewhat helpful to you. If you have questions about it, you can always feel free to shoot me a message. But basically the premise is look for your short-term swing points on your higher time frame to tell you which direction the momentum is in, and then from there go into your entry time frame. Make sure the entry time frame is in alignment using that 18 period moving average method, and then utilize your percent R to determine when the market is overbought or oversold, and then that will cue you to put orders into the market to continue riding the wave. So yeah, send me a message if you have any questions about this. Tradiustrades@gmail.com. Be happy to chat with you about it. Have a free Discord as well. If you'd like to join, just send me an email and I'll get you a link. Have a good weekend.